Good afternoon, everyone, and hey, thank you very much for joining us today. My name is Bill Kennedy. I'm a member of the New York MBA's Education Committee. I'm alongside our Education Committee Chairperson, Elizabeth Cheney. And today we're going to embrace the digital mortgage journey, origination through servicing, with Savvy. They're going to show us how to leverage the latest digital mortgage technology. But before we do that, I have a few housekeeping items, please. Use the chat function to notify us of any technical issues you may have. During today's webinar, all lines are muted except for our presenters. Throughout the session, you'll have the opportunity to ask questions. Please use the chat to do so. We'll do our best to address as many as we can during the Q&A session at the end. We'll be sharing the presentation slides and relevant resources with you after the webinar. Always stay connected with the New York MBA. We're on LinkedIn. Our website is nymba.org. And our YouTube channel is where we post recordings of all our webinars. You may have gotten some notices of this today, or in the last couple of days, we're urging you all mortgage professionals to join the Mortgage Action Alliance. It's easy, it's free, it's a way to stay informed on legislative issues that can impact the way you do business. All right, at this time, I'm happy to introduce our speakers from Savvy. So Ryan Murray is going to be our moderator today, and he is the product marketing manager for Savvy and directs the company's go-to-market strategies. Previously, Ryan worked at ICE and Notarize. Tim Anderson will be on the panel, and he serves as the executive VP, vice president of Savvy's digital mortgage strategies, and has over 35 years of industry expertise at companies well known to us, such as Evolve Mortgage, Black Knight, and Stewart Mortgage Services. And Shane Hartzler is the Executive Vice President of Servicing for Savvy with a background at Fannie Mae. Shane has extensive experience in digital mortgage strategy and operations. So gentlemen, that's impressive. We look forward to your expertise. I'm going to turn this over to you. I assume, Ryan, you're taking the lead now.
I will. Thanks, Bill, and thank you to the New York Mortgage Bankers Association for having us today. Real quickly before we get started, legal disclaimer, this is for instructional purposes, not intended to provide specific legal or financial advice. We make every effort to ensure the information we're sharing is accurate, and we welcome suggestions or feedback. So with that said, real briefly, let me touch on the agenda. While we're going to break our presentation into these main topics, we're going to keep this very conversational. I'm going to ask questions of both Shane and Tim, and we'll try to keep this conversational and relaxed as we go through. We'll start with first, like the why now. We'll discuss current trends and developments in the digital mortgage landscape. We'll compare hybrid and full e-closing workflows to help clarify the differences and benefits of each approach. We'll then introduce Mismo Smart Docs. They are key in enhancing digital mortgage efficiency and security. Following that, we'll explore the evolution of mortgage notes with eNotes and eVault and how they both play key roles in the digitization of a mortgage note. And then we'll cover default digital resolution and how digital tools can help streamline the loss mitigation process. And of course, as you have questions, as Bill said, please submit those as we go through today's presentation. We'll leave some time at the end to address those. So with that, let's get started. What we'd like to do is start with a poll question to break the ice. So you should have that popping up now. How do you perceive the impact of e-closing technology on the mortgage process? Go ahead and make a selection, and we'll talk about those results real quick. All right, so hopefully you're making your selections. I'm not sure how long the question's going to be up there, but hopefully we'll see the results here in a few seconds.
Well, either that, Ryan, or we're going to spend a lot of time talking about this one thing, you know.
I
So
guess so.
I know we didn't promise any prizes if they get them right or wrong, so that might be an incentive to get this, closed.
No, just just to kind of help guide our discussion here as we get into the first section.
Jens, I saw a note from
Sure.
somebody that the poll isn't working, and I know I wasn't able to vote on it either.
Oh, bummer. Okay. Well, I'm seeing some responses on my end now. I wasn't able to vote as a panelist, but I do see that, which is great. The overwhelming majority of those that were able to respond feel that it significantly improves efficiency and customer satisfaction. So that's great to hear. We also see that there's a few that need some more information. So we're glad to have you here today, and hopefully hopefully we'll get you started in the right direction. Tim or Shane, any comments before we move on?
No, I'm actually surprised at the high response on, significant impact. So it sounds like we got a pretty good educated group here to start with.
Yeah, that's great.
That just puts pressure on us to make sure that we take it to the next level, Tim. That's all.
Yeah. Yeah.
All right, well let's move on then. So first topic, why now? Why is this the right time for e-closing? Shane, I'm going to start with you. Can you talk about the latest tech developments, environmental factors, any policy updates that have made electronic closings more accessible?
Yeah, and I'm gonna start that question off by talking a story. So, as was mentioned earlier, I used to be at Fannie Mae. I actually managed, among other things, the e-mortgage program for Fannie Mae. And so, about 5 years ago, like 2018, something like that, I was at a conference and we were talking again. We were talking about e-closing and things like that. And the question was asked to myself and a couple of other panelists, when did we see, if we looked into the crystal ball, when would we see 50% of closings being done digital? And I said at the time, and again, this is 5 years ago, and I said probably 5 years. So I was wrong, but I was also right. And by that, I think, it is true, and we'll talk a little bit about this in terms of we're not yet seeing the levels of adoption, for e-notes, maybe for a full digital closing the way we are. But we are seeing a lot more sort of hybrid. And again, we're going to talk about some of this. And there were also several factors that hadn't yet come into play that were coming into play that I think are now in place that are also going to help. So the first sort of factor that I highlighted was the fact that at the time that we started, Ginnie Mae didn't have any of their digital collateral program in place, right? So that meant that any of the FHA, USDA, VA programs, that if you wanted to do an e-note with them, you couldn't do it because they didn't have the program in place. That program is now in place. You can now collateralize, securitize e-notes through Ginnie Mae. The federal home loan banks weren't there, so they've now jumped in. So again, if you have some of the smaller IMBs or community banks, credit unions who are doing that, now the home loan banks are there, and so those investor factors are one of the key things that we didn't have now that are helping to drive some of this adoption. The second thing, as I mentioned, is we do have a lot more investors in warehouse banks. Again, at the time, we did not have a lot of that. And so there's a lot more sort of willingness in the secondary market to be purchasing e-notes, to managing e-notes, et cetera. The third thing that I will say is, we owe a lot of where we are now to COVID. But COVID really helped to, if nothing else, this is the piece that I'll say is a lot of either homeowners or people looking to buy homes put in place some of the capabilities that we've been at. So high-speed internet, more, sort of computers, it becomes a lot more ubiquitous. People are more used to signing things electronically, et cetera, doing things electronically, because we kind of had to. And so those capabilities, it's a much more sort of easier process to get people to adopt because they're used to doing these types of things in place. And the last thing that I'll just say, and then I'll turn it over to Tim, is when we think about the hybrid capabilities, one of the things that we saw when COVID did come into place, right? So in 2020, that The lenders who had already started doing some sort of digital closing, so they were doing hybrid, they were signing some of the disclosures electronically, they were at least doing something digital. That they were the ones who, when we went into COVID, where it was much more sort of, we're not going to meet face to face, we're going to sign all the documents electronically, we're going to try to do notes, they were much better able to sort of ramp up and go to that than somebody who was trying to start fresh. And so that's always one of the things that I sort of highlight to, if a lender says to me, like, is now the right time? Why should I do it, et cetera, is you're always we don't know what the future is necessarily going to hold. And so we always want to look to give ourselves to maximize the flexibility that we have so that we're able to sort of adapt to those things when they happen. So again, if interest rates were to drop by 2% suddenly or something like that, and we had this boom, like, are we as an industry able to sort of account for and take into account those things? And so having those capabilities in place is really one of the main reasons why I really say to people, look, now is the time to do that, because you want to make sure you're ready when the time comes. Tim, what would you add to that?
You took it all away from me, Shane. No, there's I can add some stats actually in terms of mainstream adoption now that we've seen too. I mean, predominantly, having come from Fannie, Shane knows it was pretty much Fannie and Freddie that were buying e-notes. And so if you weren't a Fannie Freddie seller, you couldn't participate. And obviously, if you're a Federal Home Bank, you couldn't participate too now. But I got some stats here. To date now, we have about 250 originators, lenders actually originating e-notes right now. 43 e-warehouse lenders, which is huge now to e-fund them. Close to 34 now investors that at least can buy e-notes. So that's a big, takeout now is getting investors to buy e-notes. So 34 have at least signed up to buy e-notes. We got a lot of the servicers now doing it. The major doc custodians all support it now. So again, you've got now a lot of mainstream adoption between a lot of industry players now. They have to originate and buy and sell. The other thing that happened with COVID, as you guys know, and Shane touched on it, that now the consumers that are online that start kind of E and want to stay E, they all have high-speed internet. They're online already, so they have an environment now to be able to conduct mortgages online as well, and that's where Ron's pushing it. And we've been waiting for the Secure Act to happen to kind of nationalize e-notary like UE and eSign did. But we currently now have about 47 states. We're already got, it's almost a fait accompli. 47 states now adopt some e-notary law. So we're already pretty close to that already. And then even on the e-recording side, I mean, we've got almost 95% of all counties where the population is supports e-recording. There's 2,615 counties. So again, there's no reason now, both partnership participants and even all the players here that won't accept E. And then the final thing I'll mention, even with the e-notes, even though it's taken a long time, literally what's happened, we've seen the last 3 months, even in a down marketplace, I think people are finally realizing that the digital mortgage gives them a competitive differentiator. In the last 3 months, we went from a 7% adoption to close to 9, almost 10% adoption, just from the first of this year. So I think the lenders are seeing this as a competitive advantage as well. So
last week, the Mortgage Bankers Association released their 2023 annual Mortgage Bankers Performance Report, which revealed that IMBs and mortgage subsidiaries of chartered banks incurred an average loss of over $1,000 on each loan originated in 2023. So my question to you, in light of these findings, how can e-closing contribute to improving operational efficiency and make a positive impact on profit margins on mortgage transactions? Shane, I'll let you respond first.
Tim's gonna get mad if I keep responding because I talk so much. I'm gonna
no.
I'll try to, yeah, I know. I'll try to save some for you, Tim. So what I will say, I'm gonna talk about sort of the profits from sort of from the investor standpoint, right? So the first thing is in terms of lost notes. So again, anytime you're like, and I used to tell people, like, if you think about sort of the way the current paper process is, like people are like, well, I don't want to move away from that process. And the thing I always say is, if I describe to you a process in which you sign a paper, you put it in a FedEx, you send it to the lender takes it out of the FedEx, they do a manual stare and compare, they put it into their little basket to identify which warehouse bank they're going to use. That gets put into another FedEx. I send it off to a custodian, to the warehouse. They take it out, they do a QC on it. Then maybe ultimately it's going to need to go to a custodian, so they put it into a FedEx. Again, it's a process that when you look at that, you're like, well, that doesn't seem very efficient. There's a lot of opportunity, again, for lost notes. And all of those transactions, there's going to be transactional costs that are associated with that. And so what you get when you go to a digital transaction, when you have an e-note, is you don't have to go through the same levels of QC. You don't have to go through the different stages of sort of transacting, right? So all of those costs are gone. You have a lot more security. And because you're not having to now do some of the stare and compare and some of those things, you can move the note much faster from closing, QC, move it to the warehouse, sell it to the investor, right? And so my warehouse times can go from, again, I haven't been at Fannie for 3 years, but when I was there, what we were seeing were the lenders who were doing a lot of e-notes, generally speaking, they had dwell times on the warehouse that were anywhere from 10 to 15 days, usually for a paper note. And those numbers were much closer to 3 days, 5 days. I had one lender who was, his warehouse dwell times were 24 hours, 36 hours, right? And so it dramatically changes some of those funding costs as well. If you don't have some of the note or some of those pieces that are there.
Yeah, that's where I really do see the pickup on the investor side, right? If I can eliminate a lot of those post-closing issues that occur because of the doc or missing signatures, or and do that as an e-sign, because the neat thing about e-sign, e-closing, you cannot close a loan if you're missing a signature, as an example, right? Or if you have a critical doc package out there, it knows what documents have to be signed, what documents and so you eliminate a lot of those just clerical errors by missing a signature somewhere or a doc right there at closing. So it enforces compliance and making sure that it's done complete and compliant, so that you don't have those issues post-closing. I will get into a little thing about why smart docs even better, because the other issue is, how do I know that the data is as compliant as possible in those docs too? Because we're dealing with dumb docs in the old world. So big pickup on execution. I think, you can eliminate a lot of those post-closing costs. It's easily $200 to $400 alone, because you're eliminating that post-closing QC process. On the origination side, you're going from a 50 to a 15-minute closing. Again, there's some really good hard dollar stats out there now on reducing the time to close, reducing those errors and omissions. I mean, it's, generally speaking, it's probably around about $100 alone on the closing side easily, because you just, again, make it more efficient to do than the paper doc or even PDFs. So
I'm going to throw up another poll question before we get to the next topic, just to see where everybody's at within their own organization. So are you utilizing e-closing today? And if so, how are you using it? How far along in adoption from hybrid to a full e-closing with Ron?
And this is a good question for you, because there are different flavors of e-closing, and this is kind of identifies, the different types. So it's good info. IPEN is in personal presence of, so it's e-notary in personal presence, if nobody knows what IPEN is.
In-person electronic notarization. So still have a full digital closing, but you're doing it in person with a tablet or similar electronic device.
So we have this timer to build suspense, right, Ryan? Is that what we did?
I don't know.
Like some music or something, sort of like build that suspense also, right? Like to give sort of the impending, like it's almost to end.
I think you timed this on my response rate. That was the problem. A little bit slow on the uptake here. Yeah.
Oh, we've got one more poll question to plan for after this. We got three.
Hey, maybe we
wanna
should
be
bring that up
all-inclusive, though. We
now,
wanna-
just so we have enough time, just so it'll
Yeah.
give enough time to run through that.
There we go.
All right. Well, this is good. I mean, that we've got a pretty good spread here. 30% are doing hybrid. I actually expected that maybe to be a little bit higher. 22% with hybrid closing with eNote, and 11% are doing fully closing with Ron, which is great to see. And then still, we've got a considerable number, a third, that are not using any form of e-closing today.
I call
What
that
else?
fourth category opportunity.
Yeah. Yeah. So, well, let's talk for those that aren't, especially, let's talk about it and what the differences are. And we'll start with hybrid. So hybrid, some of the documents are signed digitally in advance of closing, typically any type of ancillary document that doesn't require notarization. And then you're still closing with ink for the remaining docs. So maybe Tim, I'll start with you this time instead of Shane. What are some of the advantages of hybrid closing for lenders and borrowers in terms of accessibility, convenience, scalability, especially in places where remote online notarization isn't fully legal?
Sure. Thanks, Ryan. So, two kind of flavors of a hybrid. Hybrid, if I can e-sign a majority of the non-notary documents, which are normally the lender disclosure docs, most cases, the lenders are already getting the initial disclosures e-signed. This is getting the final disclosures e-signed as well. So it's the same process for the initials as well as closing docs for the lender docs. And that's in a closing package, that's close to 85, almost 95% of those documents then can be executed in advance of the actual closing. And then the remaining, the notary ones that get papered out are the ones that actually get notarized and wet notarized and signed. That's why I say you go from a 50-minute closing and have to execute all the documents of closing just to doing now the notary documents, which are the hybrid papered out in 15. Big pickup. Again, you reduce errors, omissions, time to close. It's a better consumer experience. All around, it's just, it's a good way to start. And that's the way we see majority of the lenders that dip their toes into it. They start with a hybrid.
Shane, any thoughts like in terms of maybe security, flexibility?
Yeah. So I think you actually those are both of the two things that I would really sort of highlight. So the first is flexibility, and by flexibility, what you really want to do, what we've found with consumers, particularly consumers, is you want to give them flexibility and give them options for how to do the signing. And so the more that you can have capabilities in place to do that, you want to do that, right? So as it relates to sort of the flexibility, it means you definitely want to be able to at least sign the disclosures ahead of time, shrink the amount of time that you're actually going to be sitting at the closing table with the closing agent, notary, etc. I always recommend that you're doing the e-notes. Again, some of the stats that I talked about in terms of the dwell times, the capabilities, the removing of the lost notes, etc. All of those savings really come about when you have the e-note. So I highly recommend that. And then when you get to the notarization, one of the things I was going to say, like we talked about, Tim talked about, sort of all the stats around, how many states allow for Ron and how many counties and e-close. One of the things that I've actually been a little bit frustrated with, particularly with lenders, were they always used to say to me, "Oh, well, we have this patchwork of notarization rules across the United States, so I'm not going to go fully digital because, like, I don't want to have to manage all of that. Like, it's just too overwhelming for me. I'm going to wait until we have the Secure Act and there's national acceptance." And the thing that I would say to a lender is, you today in a paper world don't really care about how the notarization is going to be done, right? Like you don't, in your closing instructions, you're not saying, hey, make sure that the notary uses, I mean, maybe you are, but like use blue ink, not black ink, and make sure that, you look at two forms of, like, you let the notary worry about the notarization rules. And to some extent, I like to think that that's also where we are with some of the electronic notarization, right? Like the title company is going to know what the capabilities are. They're going to have the capabilities or not. You as a lender, your role is to make sure that the note gets signed and that you have all of the lending documents and the disclosures and all of that. And so I'm really sort of saying like that's the reason why hybrid is important. The reason why having capabilities to eNote is important, because those are the things you can control. And those are the things that you can do today, 100%, any location, any state. So go and do those things. Focus on the things that you can do and you can do well. And then let, title and notary and all of those things sort of work their way out, and those capabilities will come along. So those are the things I would say there. Um, and I think that's a really, really, really important point, because it means that it gives you some freedom again as a lender to be able to do the things that you want and to be able to implement it. Again, the other thing that I was talking about is it can feel overwhelming if I'm like, oh, you got to do everything all at once, right? And so going hybrid gives you the chance to be like, I'm going to take this step and I'm going to do the eNote and I'm going to get that right and I'm going to do that well, and then I can move on into other things. And I think it's a much easier sort of process for people to get their head around if we take sort of this start small and build up kind of a incremental sort of approach.
Yeah, well said. So to take it to the next level, though, outside of obviously convenience, what does the introduction of Ron do? I mean, in terms of getting a true digital mortgage end to end.
Yeah. So I'll start, Tim, and again, I'll let you join in. The couple of key things. The first thing that I'm actually going to highlight, Tim, I'll let you cover sort of the consumer experience and some of the flexibility and what we saw there. What I'll do is I'll talk about security. Again, we have sort of these notions in the world that, this paper process is the secure process, right? And as long as I'm showing a note, right? The role of a notary is to do two things: verify who you are, who you say you are, and to witness you signing the document. So if I say that the role of the notary is to verify you are who you say you are, I'm going to do that by I'm going to bring you some sort of ID, my driver's license, my passport, something like that. And the notary's going to look at that and they're going to say, looks like you've gotten older, but yeah, it looks like it's the same, right? Like things like that. What we can do with Ron, or what we can do with the technology, is we can actually go to the source systems and verify identity through the source systems, where I'm not relying on somebody to look and say, yeah, it looks like you, I guess, right? And so we're taking away a lot of that guesswork. And so I'm going to the DMV and verifying through the DMV. I'm verifying through, some knowledge-based questions through what we call the KBA, again, the knowledge-based assessment. I am having you hold up your ID in a video and take a picture with you. And so there's a number of things that we can do from a technology standpoint, from a security standpoint, to confirm you in a much better way than I can in the paper process. And so again, that first and foremost, I think, is a reason why we want to be doing some of that. Tim, I'll let you cover some of the flexibilities as it relates to sort of consumers and giving them sort of what they want.
Thanks, Shane. Yeah, so to complete the full closing, and it really is about convenience, right? So again, some of the stats are that we found on the origination side, at time of app initial disclosures, they're almost doing almost 90, again, it varies, but about 90% of the initial consumer starts E, right? They're getting their disclosures done electronically, they're doing the e-sign. So they're already predisposed to having the same kind of experience at closing, And at closing, then the big thing here, especially for states that require additional witnesses or attorney states where they want to review the documents maybe ahead of time, and they can come in through the video and do that and get that out of the way, so that doesn't take up the time of closing, answer all the questions. That was the really intent around the CD being delivered 3 days ahead of time and review the docs. It's just ability to really close whenever you want to, right? A lot of the, Ron was really getting adopted when you had military people overseas, right? And they were closing on home. Now, I mean, if I'm an attorney and I've got, again, it's not an issue because we don't have, 20 closings being scheduled in a day. But if you got to schedule one in the morning and go in LA and go across town later, and you got 2 witnesses that have to be there because you got 2 borrowers and they don't show up, you got to reschedule. And these things happen all the time when you just can't get people there at the same place at the same time. So Ron eliminates all that. You literally, then you don't have to even be there at the actual same time. You can have somebody sign earlier, somebody sign later because they were, caught in an airport somewhere, but they can get it done that same day. So big convenience factor, and the ability, like I said, even with a video, to come in before you close, even a couple days, and execute the non-notary documents. And if you are, the only thing about notary If they have any questions around the legal docs, they can't answer them. That's why you want to have an attorney online or cover these in advance with loan officer. Again, you don't want to have those issues at closing. You want to have it as clean and as smooth as possible. And Ron makes sure that you have all the right parties there at the right time, all the time.
I think, Ryan, the last thing that I would just add before we go and talk a little bit about sort of the laws and some of those capabilities is, you know, one of the things I'm going to keep emphasizing is sort of the flexibility and you providing flexibility to your customers. And so what we find with Ron is, and having at least those capabilities. So if you have the capability to do hybrid, iPen, Ron, all in one platform, what that really does for you is it enables you to meet sort of customers where you are. So I was with the CEO of a title underwriter one time, and she was giving the example of she had gone and talked to a lot of her had talked to a room full of some of her younger employees, and she was like, "Why aren't all of you like?" Why isn't Ron, you know, sort of taking off? Like, why would any of you want to like sign things either in paper or face to face? Like, isn't Ron like just so much better? And the answer that they gave was, when I'm buying a home, first time home buyer, like that's an important event, and I want it to be a celebration, and I want to feel like oftentimes that's like the first thing that I'm doing to make me feel like I'm an adult, right? The first adult sort of thing. And so I want to go to somebody's office and feel like I'm shaking hands and that there's a transaction that's happening there. And Ron doesn't necessarily always give me that. Whereas somebody like me or Tim, who've been around for a while, a little gray in the beard, who've done a number of these transactions, right? Like I don't have that same need to go and do that. Like I don't want to go talk to somebody. I want to be able to do everything. I want to sign the documents up on my time. So again, having those capabilities, I would much rather do Ron every time, all the time, because I know the process. I know what it's like. I don't want to ever have to talk to anybody. I just want to sign the documents and go. And so what these technologies do is enable you to say to your consumer, rather than dictating what the terms are going to be, you can say, look, I have this option for you. How do you want to do it? And now you're providing consumers experience, but also, having some of the benefits that are going to come behind that as well.
Yeah, one last point on that. That's actually an excellent thing, like with HELOCs, where you're doing a second, let's say, and you don't require title, and they just want to go in there and say, hey, I've already got my first. I just want to get a quick second, right? I don't have to go through the whole, like I'm going through a first time home buyer process. So it's all about convenience, being quick. Yeah.
Yep. Well, I advanced a slide, and Shane, you already touched on this when we were talking about Ron, and initially you were talking about security. New York did something unique in terms of Ron legislation when they introduced their law, in that they adopted some additional fraud prevention measures from the National Institute of Standards and Technology, and platforms like Stavies and others that are compliant with New York Ron laws introduce these additional security measures that include, in Stavies' case, biometric analysis, social security number validation, geolocation tracking, multi-factor authentication. Aside from that, I mean, Ron just prevents some very core fraud prevention measures in terms of the technology that we apply to signer verification. We don't have to spend a lot of time on this. Shane or Tim, any comments on some of the other fraud prevention measures that are just naturally occur when you're doing a closing through Ron?
No, Shane did a good job explaining. I mean, I do hear though that the secretaries of states, when they're revising their Ron laws, again, those that are not well educated, the uneducated say, well, there's a potential for fraud because they hear about the cyber attacks and cybersecurity issues that are happening with some of these things, right? And it's just the opposite. Like I said, this thing adds a level of foolproofing and authenticating of all parties in that process than you wouldn't have in a paper world at all. And I think once people really understand the multiple levers we take to authenticate those borrowers to eliminate ID fraud, it's really actually going to be the only way you can eliminate. I don't want to say ever eliminate it, but ensure that it's a much more secure than we have in the current, paper e-notary authentication laws.
All right. final poll question. Let's get an idea of where our audience is in the mortgage lending process. So what's your role?
Now we get to find out who
Just-
our audience really is. We got to
It
declare.
is, yeah. We got three more topics to hit here in the final 15 minutes or so. So this will just help us craft our delivery a little bit to the audience. Let's see what we have.
You mean we want to be more relevant, Ryan? Is that what we're trying to do? I like that approach.
Yeah.
Yeah. For our audience.
So I'm assuming one of these on a 60-second timer. Let's see here.
Hi, I'm Nicole Hunt with Sandy Hook Promise. I know this.
They pop up. Oh, here they are. All right. Well, we got a pretty good spread. We're missing post-closing and secondary marketing, unfortunately, but we've got loan origination and compliance and legal and some closers, technology. A lot of technology folks on the call today.
Well, then the
All
next
right.
topic. Well, then the next topic, you can go deep, Tim.
You can.
Oh no. Okay.
Yeah. So Tim, I mean, Mismo Snart Docs, let's introduce the concept of them. Can you just kind of introduce what are the main challenges traditionally with, traditional mortgage documents, and give us an explanation of how Smart Docs are going to help us tackle some of those issues?
Okay, for your non-technical people, I'll try to keep this in layman's terms, and I'm not a technical person either, but Smart Docs have been around a long time, and Fannie and Freddie, I think it was, Shane, was it 2002, 2003 came out with a Smart Doc spec for the E-note. The acronym is they're secure, manageable, archivable, retrievable, transferable. The new version that was announced just in January is called verifiable. And that's why I was hoping more of the secondary marketing people would be on here. But it's good for the originators too, because now you can actually interrogate the data, the source data that's generated, like the fee data, any compliance data, the APR data that's shared across all documents like loan amount, including the title documents, make sure they're accurate, can be verified systematically for compliance inside the document. That's the difference. When you're running traditional doc prep, you've got a PDF dumb image with a data payload. And what you don't know is, does the data and the payload that you see, was that actually what got signed at closing? There's no assurance, because you might have a version 3 of the image and version 10 of the data payload. This ensures that what gets seen, signed, and delivered at closing, in other words, on the legal documents that are actually an e-close, which wraps a tamper-evident seal around and locks it down, you can, on the investor side, then that's what we said, you can close with confidence and fund next day with certainty. It is as clean, current, as compliant as possible, right up to the point of closing. It eliminates these things that happen outside the system of record, the LOS, offline at closing. That's why people have to rescan, and even with AI, have to look at done PDF documents and make them smart again and say, okay, what happened at closing? Because it went dark on us. It's a big gap that's missing. Now with e-close and Smart Docs, it stays transparent from app all the way closing investor delivery to all the way to servicing. It's a huge, this will be a big change on how we verify data in docs and ensure that there's actually trust in the data documents from an electronic compliance perspective. When I explained this to a technical person, he goes, well, this is like blockchain inside a doc. I said, I'm going to use that because blockchain, before AI was such a buzz, this is even better. So once investors and originators actually understand that I can actually close with confidence that the data and docs actually match and are compliant, I should be able to get to next day funding. And that should revolutionize the way we do, loans today.
So I just want to add to this, because again, when I was at Fannie, we were taking advantage of this again, as Tim mentioned. Fannie and Freddie have been requiring smart docs to come in on through the e-notes for some time. What Tim's talking about is now not just the e-note, but the entire portfolio of documents to have sort of these capabilities. But let me give an example of what we did with the e-note and then explain why that sort of becomes relevant across the portfolio. So with an e-note, when an e-note gets delivered into the GSEs, what they'll do is they will actually, as Tim mentioned, there's two components to it. So there's the view layer, that's the piece that the homeowner saw, that they signed, etc. That's a piece in a traditional world, that would be the paper document. And in a traditional world, somebody would need to look at that document and do the stare and compare it to a loan, whatever the data was in the loan delivery system, and say, does the data that's in that note line up with what you told me in the loan delivery system? And if that's the case, then I'll say, yes, we can fund the note and I'll buy it, etc. What we can do when we have a smart note is, because there's that data payload that exists within that as well, we can now automatically interrogate that, take that, compare it against the data that came over in the loan delivery system. Nobody has to look at it. I can automate all of that. I can require 100% data match. So even if it's like, place versus PL or street versus ST, like we used to require 100% of that data match, or we would send it back. But what that means is now I don't have to have anybody looking at it. I don't have to do it. So it's an instantaneous sort of process. So again, as Tim's saying, it's speeding up sort of what that looks like. So now we're talking about taking that data payload, and it's not just the e-note, but it's everything that's associated with the entire portfolio of docs. And I can do the same thing. So I can now interrogate all of that data. So think about now, like when you're selling to a correspondent or you're selling to somebody else, now everything can be verifiable. I don't have to have anybody look at it from a QC perspective. It's just going to change. Again, I'm reiterating what Tim said, but it's going to change sort of what that process looks like in terms of delivery and compliance in QC.
Yeah, 100% of the documents and data can now be verified for compliance versus the 10 or 20% that you do through the old OCR way. That's where you need to get to. I know that 100% of the data in the docs are going to be compliant before I purchase them. That's a big pickup.
So Shane, I'm going to move on to our last topic, digital default servicing. So what are some of the key challenges that servicers encounter in traditional loss mitigation processes, and how can digital solutions effectively address these issues?
Yeah, when we talk about sort of offering, homeowners with digital solutions, right? We always, like, what we just spent 45 minutes talking about, the origination and why all of that is important. But the core capabilities that we talked about, providing flexibility, making it so that a homeowner can sort of engage with the servicer when they want to. They can get information. They can even schedule times to like sign docs, etc. All of those things that are true in origination are true in loss mitigation also. But in loss mitigation, the thing is, you have sort of a probably timeline, but you also have a distressed homeowner, right? So there's, like, now they're frantic because they want to do things that they can stay in their home. They're concerned about the things that are causing them, either short-term hardship or long-term hardship, right? And so what we want to do, again, in the digital world is we want to meet them where they are. We want to make it so that they can get information, they can apply for assistance, they can have transparency and visibility into what's going on in the process, which we've never had before. They want to be able to know, like, how long is this going to take? What are my next steps? If I need to upload additional documents, I can do so. And all of that is all sort of laid out. So we're changing the way sort of the homeowner engages with the servicer, so they don't have to call in, they don't have to be on hold or wait for somebody. Like, they can now select how they want to do it. And so it's a much more empowering experience. So again, all of what we've been saying about all of these digital capabilities is meeting people where they are, providing flexibilities, and allowing them to sort of say to you, this is how I want to engage with you, this is the things that I want to do, versus having that process dictated to them.
Mm-hmm. And Tim, is there any opportunity to introduce, there's an electronic note, but there's still like an electronic agreement being signed. Is there any way to leverage smart docs Volt, any of that underlying technology on the servicing side?
Yeah, again, you have data integrity issues everywhere, right? Because the problem is today, right now, is we take documents, then we print them out, then we rekey them, then we print them out, and then we scan them, and so every instant where you have to get data off a document introduces issues with data, right? With E, and that's where the vault comes in, I can stay E from app all the way to servicing if you have smart docs for all the documents, because these are shared data fields, right? Like loan amount, when I'm producing on the lender side, need to match the title docs. They need to match the servicing, or when the fees change, or when the home equity loan comes back in. Like Shane hit a just simple name and addresses that are misspelled on multiple documents are wrong, right? Sometimes we don't know who the deed holder is because they spell their full name and their different name, and it just creates these issues. When I make a data change on a shared document like a loan amount, it knows every data field in all those documents to update immediately. So that's how you ensure data integrity. They're not fragmented and broken up. These are really arced and linked by data fields. This is where Mismo comes in and standardizes that data. So when you update that document, if it's smart, the source system of record is always going to be current. That's the key. Sometimes we update data and then documents, but they're different systems and they never sync. Smart Docs links them together and ensures that whoever touches that data at the lifeline alone will always, like I said, kind of, how do you maintain that source of truth? This is how you get there.
And Shane, one final question for you on this topic. How does introducing a digital platform to servicing, like we're describing here, how does that help servicers handle changing regulations, adjust to new guidelines? What are some of the advantages that they get?
So I'm going to answer the question even broader than what you said, Ryan, because it goes back to what we've been talking about the origination side as well. Mortgage is a highly regulated space. Origination, that's true. Servicing, even more so. Default servicing, even more so, right? Like there's a lot of visibility, a lot of regulators, a lot of people looking at and asking questions around how did you do things? And what the digital capabilities, what the digital tools enable you to do is to be able to basically show your work, right? Here's when somebody, applied for assistance. Here's how long it took me to make a decision. Here are the things that I asked for. Here's when those things got turned in, right? All of those can get captured in an audit trail much easier than it is in a paper process where I'm still requiring somebody to key in, right? What this is doing is capturing all of those activities, capturing all of those events that happened in the workflow, but it's doing that naturally. And then I can print that out and show that to a regulator and say, see, look, this is how I did. I did meet all of those guidelines. So I think that's the important thing. The other thing is, from an underwriting standpoint, again, this is true on origination as well as in servicing, like if a policy changes, whatever, particularly if I have investor overlays, correspondent, changes, things like that, the technology enables me to make those changes much easier and ensure that I'm going to continue to be in compliance versus some of the paper processes where I have to make sure that somebody is interpreting my policies the right way and is making the right decisions. Technology is trying to take some of that decision making out of the hands of someone who you have to train up for, and saying, let's just allow the technology to do a lot of that. And so I think that's really where some of those benefits come in. And again, it's on the origination side and on the servicing side.
I know we're running out of time, Ryan, but what Shane said is very important, because these lawsuits that happened, a lot of people probably weren't around when the meltdown happened, but they went to the paper file and they said, prove what you said you did. And they couldn't. It wasn't in the paper file. That's where the loss notes. That's what I said with the vault and keeping it digital all the way. You have electronic evidence of compliance, date and timestamp, when they came in, when they acknowledged, when it was received, verification of CD delivery. All that is there. So now you have the ability to defend yourself. And anybody ever comes back 10 years from now and said, did you disclose properly? Right? It's all there. And that's huge from a compliance perspective. Protect yourself.
That's a great point to end the presentation on. So we wanted to allow at least 10 minutes here for questions from the audience. So please use the Q&A panel to submit those, and we'll do our best to answer them for you. And I've got one for both of you, just in something I was thinking about. You both have worked with many lenders over the years. So where do you find that most lenders get stalled or see the biggest hurdles in terms of evaluation, implementation, or execution of an e-closing workflow?
I
No,
have
I'll go.
I have a lot, Tim. I'm sure you've seen a lot. I'll let you start.
Well, the biggest one, if I had to pick one, is nobody's asking me for it, right? I hear that from everybody. And I use the example. I says, you didn't think Stephen Jobs waited for somebody to ask for an iPhone before he went out there and changed the world? You know, that's how you get market share. That's how you create a competitive differentiator. If you wait for somebody to ask for it, it's already too late, right? Be a leader. Go out there. Use this as your competitive advantage to change the way business is done. And the last point is, we're saying go where the consumer is. The consumer's on their cell phone, they're online. That's where they want to conduct business. They don't want to go offline. They don't want to do it paper. You know, so go where the consumers are and make it easier to do business with you than somebody else.
So the answer that I'm going to give, and I'm going to give two answers, and they're going to sound contradictory, and I don't mean that to sound contradictory, but the first thing that I'm going to say is I think people fail because they try to do too much all at once. And I said it earlier, and I'll say it again. It's really important that you try to build this out incrementally, start small, make sure that you understand, because there are going to be process changes. There's going to be change management that's going to be involved. And so start small, make sure that you have worked out some of those, those kinks before you roll it out to the other sort of folks. There are two schools of thought as it relates to that. I've had some lenders who have started with smaller branches, started with some of their smaller production areas. Again, the idea being you don't want to necessarily impact your highest volume sort of areas. You want to give yourself time to sort of build up to that and then go to that. At the same time, we also know that from an adoption standpoint, the thing that really helps to drive adoption at this is the LOs. The LOs are sort of critical for all of this. Again, what Tim said is really important, where everybody's like, well, I'm waiting for everybody else to be ready. And it's like, you know what? Like no one's ever going to say they're ready. So you got to kind of go. So the LOs become very important from an adoption standpoint. So that's the first thing. The contradictory thing that I'm going to say is you also can't adopt digital and still think you're going to have these bifurcated processes where it's like, oh, well, I'll do digital sometimes and I'll do paper sometimes, right? You have to fully commit to this because it requires sort of a commitment, and it is going to require you to do things differently. And so you have to at least say, we're always going to do e-notes. We're always going to do the disclosures electronically, right? Now, again, you can incrementally build to that, but once you do that, you can't say, oh, I'm sometimes going to do paper and I'm sometimes going to do E. You have to fully commit to the E in order for it to work, because you don't want to have these bifurcated what if scenarios where it's like, sometimes I'm going to do this way and sometimes I'm going to do that way. That's just a recipe for disaster.
That last point, Ryan, is really critical because you see companies, I won't mention the names, but the big online lenders, they didn't say this is an exception. This is the way we're going to do business. They mandated from the top, they bought into it, and they drove this adoption. When you leave it optional, then people aren't going to change. They know what they know today, and they're just comfortable with a broken system. So that's very good advice, Shane.
You're welcome.
We got a couple questions from the audience that are coming in now. First one from Nancy: do all platforms have the ability to do all loan documents as smart docs?
Oh, I'll take this one. No, I think that is kind of not a plug, but most doc preps have either a template or they could say dynamic, but they're building still at the end, they're still producing a dumb PDF. The system we actually have is native XML, which means that it's already smart. We start data wise within the system of record that's pushing us that data. And then when we're ready to produce something, output is an image. It's just the opposite of the way most doc prep systems work. That's why we have kind of the secret sauce of jumping on the Smart Doc V3 version, because it's going to be very big.
Shane, a question for you. Do you find that most distressed borrowers that use the dashboard complete the process without having to talk to a person?
So my answer is going to say, I feel like I say this a lot. It's going to depend. I think what we find is for our customers that are using the dashboard, it depends on what the hardship is and how. And so a lot of the forbearances that the homeowners are getting, particularly like a disaster forbearance, where our dashboard, for instance, has an integration with FEMA, and so we can validate that you're in a disaster, that the homeowner's in a disaster area. So we can automatically route that. We automatically route like payment deferral. So if they're eligible for payment deferral, there's a streamlined option where they can just go and get put right into that. So a lot of the forbearance, the payment deferral, a lot of the streamlined options that we're seeing now in servicing, that's where the homeowners are going directly into that, and they're never having to talk to the servicer. Yes. There are some where there are some situations where maybe they need to call into the homeowner. What we're really trying to do again with the dashboard is to give statusing to eliminate a lot of those reasons. When we talk to servicers, a lot of the reasons why homeowners are calling in is just to say like, hey, did you get my document? I uploaded a document yesterday. Did you get it? You haven't told me anything. Like, what's my status? Where do I go? And so by giving a lot of that information, we do find that we can reduce 50 to 75% of the calls that are coming into the call center for a lot of those types of reasons.
Well, I'd just like to thank again everybody that's on the call that stuck with us to the end for participating with us today, and thanks again to the New York Mortgage Bankers Association for having us.